I'm going to start with an area called as transfer pricing. Again, this is an area which has more problem solving, lesser of theory angle, but in the recent exam a 10-mark theory question came. Even from this chapter. There was only one area which was theory based, but even from this chapter a theory based question came. First let me give a broad overview of transfer pricing. Now what is transfer pricing is when an organization has multiple departments, or multiple divisions. A transfer pricing can be between one department to the other department in a service industry. In a manufacturing company, there could be some 5 divisions of a company. For example, ITC has so many divisions. There is a paper division, there is a hotel division, there is a tobacco division, there is an FMCG division. So many divisions are there. It's possible that for the paper division, the employees, the top management who works there, they will have to travel. When they travel to multiple locations, they need accommodation to be provided. Now this accommodation can be arranged by the ITC own hotels itself. The accommodation can be given by the own hotels itself. But what happens is an organization prepares a profit statement for every division. They prepare a profit statement for every division. Why do you prepare a profit statement for every division? Is there is going to be a divisional head. This divisional head would be paid bonus based on the profits which they are making. So now when I want to use the own hotel for the purpose of accommodation, ITC hotel will charge some price for ITC tobacco division. They are going to charge some price. This price is called transfer price. This is neither the revenue for ITC limited nor the cost for ITC limited. This is neither the revenue for the ITC limited nor it is the cost for the ITC limited. So technically transfer price cannot impact my profits. But what will happen many a times is if you fix a wrong transfer price. Let's assume the ITC hotel, there are 50 rooms still which are unoccupied. Demand is not there, 50 rooms not occupied. The variable cost is only 1500 per room night. If you occupy, you will incur 1500 rupees per room day. That is what ITC is going to incur. Now the FMCG division goes and says that we need 20 rooms on a daily basis. You please provide us 20 rooms on a daily basis. Demand is not there in the market. They say we will charge you 6000 per night. Internal charges. Okay, these are internal charges. 6000 rupees per room per night is going to be charged. You have a similar hotel in that vicinity which is charging 5000. Your cost is only 1500. One division wants to charge 6000 to the other division. If you are the divisional head of FMCG, this 6000 will go and hit your P&L, will hit your individual P&L. So it does not impact the overall profit, but it will hit your P&L. If you are the manager of FMCG, you will say let's take it from outside at 5000. You are not going to agree to a 6000 rate because the facilities are same. Everything is same. So you will say I want to pay only 5000 rupees per room night. He is not ready to agree. He is not listening. He says give me 6000. The company, if there was no transfer pricing, if there was no individual, all this was not there, what company would have ideally done? What should the company do? Should they use their own accommodation or outside accommodation? Own accommodation is costing how much? 1500. Outside accommodation is costing 5000. Your own accommodation cost is only 1500. Outside accommodation cost is 5000. If you charge the transfer price of 6000, FMCG will say own accommodation costs 6000. Own accommodation is costing 6000. In books what will happen is I will put 6000 as an expenditure here. In another place I will put 6000 as a revenue. There are two divisions and that division will say less 1500 is the cost. So one division will make a profit of 4500. Another division will have a cost of 6000. Net in P&L 1500 will be the cost. Net in the P&L the cost will be only 1500. If you don't do this, net in the P&L the cost will be 5000. If you don't do this, in the profit and loss account your expenditure will be 5000. If this happens, transfer pricing will impact the profit. If this happens, transfer pricing will impact the profit, and the profit got impacted because of a wrong decision. It did not get impacted because transfer price is not going to increase your profit, reduce your profit. It can't do any of that. Transfer price will impact the profit if you make a wrong decision. If you take a wrong decision because of a wrong transfer price. In this chapter, you will learn what is an ideal transfer price range. What should be the range of the transfer price. In the same example, if there was an outside demand, for these rooms, and let's assume that outside demand is at 7,000. That outside demand is at 7,000. This is 6,500. Outside is 6,500. You are charging a transfer price of 6,000, which is wrong. You should charge a transfer price of at least 7,000 because you have an outside demand for 7,000. So your cost now is 7,000 per room night. If you occupy this, you lose the opportunity of earning 7,000. So your cost should be minimum 7,000. Outside it's available at 6,500. Better to go for an outside hotel. In this case, if you fix 6,000, FMCG will be happy to do this. They'll say, I'm okay to take the room because outside is 6,500, whereas I don't want them to use the internal room at this point of time. So transfer pricing can impact the profit if the transfer price which a company fixes is outside the TP range. You will understand about TP range in some time. But if it goes beyond this transfer price range, it will unnecessarily impact the overall profit. For example, if you don't have transfer price and I ask you to make a decision, you say we should use internal accommodation. If that's the decision, with the transfer price also the answer should be same. If you give me the same answer, then TP is not impacting the profits. If it is a different answer, for example, a company can sell 5,000 units, 10,000 units, 15,000 units, 20,000 units, 25,000 units. Different units can be sold depending on the demand of the product, depending on the price. You change the price 5, 10, 15, 20. I told you to do an analysis. You said optimum units to be sold is 20,000. Then I fix a transfer price and now you are suddenly saying optimum is 15,000. If you change the answer, transfer price has impacted the overall profits of the company. You will see problems like this where transfer price is going to impact the overall profits of the company. That's one part. So problem solving will have where you will have to calculate transfer price range. First, fixation of transfer price range. After fixation of transfer price range, you will have to see whether the transfer price is within the ideal level. If it's within the ideal level, problem gets over. If it's outside the ideal level, you will have to see whether you can shift it to the ideal level. Maybe managers agree, sometimes managers don't agree. For example, in that hotel example, I told them that please fix less than 5,000. The hotel division guy is not ready to listen to this. He is not at all agreeing. He says, I'll charge only 6,000. But I am saying less than 5,000 also you make money. He is not understanding it. Then there is something called as how do you resolve a conflict. There are two ways to resolve a conflict, something called as dual rate transfer pricing system and two-part transfer pricing system. You will understand that as we proceed. So how can you resolve this conflict? Another angle which will come is called international transfer pricing. How do you fix transfer price for international transaction, or how forex can play a part in transfer pricing. These are the broad areas which you are going to cover. Also, normally till now theory questions have come from this chapter, but theory question used to come from how to resolve a conflict, something called as dual rate transfer pricing system and two-part transfer pricing system. In one of the recent exam, they asked what are the methods in which you can fix a transfer price. Methods can be like full cost based, variable cost based, competition based, similar to what you did in pricing decision, but that was an exam question, and you also had to explain what are the advantages and disadvantages. So it will get indirectly covered when I solve problems, but I'm being honest, I did not cover it as a separate theory area. When I did the classes. It is there in the theory. It's not, this was there even in market based transfer pricing system, marginal cost, standard cost, full cost. So this was there in the theory, but I did not cover this as a separate area when I took my classes for the past batch. This batch maybe I'll have to discuss this also. It can be cost based, it can be on market price based, or it can be negotiation based. So that is also one area which we will discuss. So transfer price refers to the price charged by one division to the another division. Division can be within the company also, or it can be sometimes even within the group also. You have Tata Group. For example, Tata Motors wanted some software services. For software services, you can use the services of Tata Consultancy Services. So there also you can try to use the concept of transfer pricing. Whatever you learn in transfer pricing, indirectly you can try to use that concept. And when the price is fixed, because if they go beyond the range, Tata Motors will not take the services of TCS, they may take the services of Infosys or someone else. So when you are trying to do something for your own group or own division, for us both are same technically they are both same. The only thing is there is also a taxation angle which will come when it is two companies. If it's within the company, taxation angle will not come, because tax authorities are least bothered about it. Tax authorities will also come, taxation will also come into picture for international transaction. In fact, it is covered as part of your income tax, also has something called as transfer pricing provision, which will come even for, I will not discuss about those provision, but those concepts will come for your international transaction, because what organizations will try to do is, transfer pricing normally cannot impact the overall profit. Whatever transfer price you fix, overall profits will remain same as long as you take the right decision. But when it is international transaction, the transfer price can impact the profit after tax. It cannot impact the profit before tax. What organizations will try to do is, they will fix the transfer price in such a manner that you report a higher profit in a country which has lower taxes, and you report a lower profit in a country which has high tax rate. If India has a tax rate of 50% and Singapore has a tax rate of 10%, if you are selling something to Singapore or buying something from Singapore, if they are group companies, you will try to fix the transfer price in such a manner that Singapore makes maximum profit, India makes lesser profit. In that way, what will happen? In India you will pay tax at 50%, there you will pay tax only at 10%, net you will say 40%. So these were happening, that is where those transfer pricing provision, arm's length provision and all came into picture. Okay. Let's first understand how do I fix a transfer price. So this is on the TP range. Okay, first is on the basis of supplying division. Supplying division price is variable cost plus opportunity cost. Variable cost plus opportunity cost. I'll give you time to write this, listen for some time. You may have to write this, but I'll give you time for this. Or marginal cost plus opportunity cost. What is marginal cost? Is additional cost which can technically be equal to variable, but the marginal cost will keep changing. For example, for the first 10,000 units, the marginal cost could be 20 rupees. Next 10,000 units, it could be 25 rupees. Then it could be 45, then it could be 50, it could be 65. So the formula is variable cost plus opportunity cost. In that hotel example, the transfer price of the hotel division should be 1500 if there is no opportunity cost. If there is an opportunity cost, 1500 plus that external revenue which you are making, which is 5500 rupees of contribution you are making, 7000. So if you have any outside demand, please charge variable cost plus opportunity cost. Technically, I used to give two different formula. I am giving only one formula. It's variable cost plus opportunity cost. Opportunity cost can be zero also. Opportunity cost can be zero. Opportunity cost will come into picture only when there is a capacity constraint. If there is no capacity constraint, there cannot be any opportunity cost. And opportunity cost will come into picture in case you have to lose outside demand. In case you have to lose outside demand. If there is no loss of outside demand, there is no concept of opportunity cost. This is called minimum transfer price. This is called minimum transfer price. This is also called as cost of making the product. In marginal costing, you would have learned cost of making versus cost of buying. This is technically called cost of making the product. So for the hotel division, one room night variable cost is 1500, then cost of making is 1500. If there is an opportunity cost, then cost of making or cost of using in-house facility is 7000 rupees. If you end up using in-house facility, the cost is 7000 rupees. So variable cost plus opportunity cost or marginal cost plus opportunity cost. Next is receiving division. Now receiving division will have two scenarios. One is called affordability and second is called availability. Affordability and availability. What is affordability is how much can I afford to pay. For example, I am going to use a product from division A. So division A, I have my product which I sell for 200 rupees. Okay, this is the product I sell, second division. My own cost is some 60 rupees. My own cost is 60 rupees. Then I have to take that product, use it and then sell it. Affordability criteria says you can afford to pay maximum 140. This will lead to zero profit, zero loss. You can afford to pay maximum 140. If you pay anything beyond 140, you will make negative contribution. You will make negative contribution. You will not sell this product itself. So affordability criteria basically says what should be the transfer price so that I earn zero contribution, so that I earn zero contribution or technically zero relevant profit. If the fixed cost is relevant, so that I earn zero relevant profit. I am ready to pay extra also. How much can I afford to pay is what we are trying to calculate. How much can I afford to pay? The formula for this is selling price minus further processing cost. What is further processing cost? Is processing cost of the second division. Processing cost of the second division. Second division will sell something for 1000 rupees. Their own cost is 800 rupees. Then I can afford to pay only 200 for the transfer. I can afford to pay only 200. That's the maximum I can pay. If you tell me to pay anything beyond 200, this is a loss making product. At a contribution level, it's loss making, which is not. Profit level is the next analysis, but at a contribution level, if it's loss making, then I can't do anything. So selling price minus further processing cost. This formula you can use if there's a constant selling price. Constant selling price means the selling price remains same. We'll see problems where they'll say 20 rupees price 1000 units, 25 rupees price 800 units, 30 rupees price 600 units. As you change your price, you will see an impact on volume. For that you have a formula called NMR. I'll explain what is NMR later. NMR at optimum level by incremental units. I'll give you time to write. This is called differential selling price. This is called differential selling price. Basic rule is simple. What will lead to zero contribution or zero profit or zero incremental contribution, zero incremental profit? What is incremental? You will understand later. But basic logic is anything beyond this I cannot afford to pay. Anything beyond this I cannot afford to pay. Let's assume I can afford to pay 140 rupees. I can afford to pay 140. What is availability criteria is external purchase price plus or minus change in cost. I can afford to pay 140, but in the market it's available at 110. In the market it's available at 110. The transfer price as per availability criteria will be 110. The transfer price as per availability criteria will be 110. What is availability criteria is if you have this product available in the market. If you have this product available in the market. In the market it's available at 110. I'll pay only 110. There's something called as plus or minus change in cost. What is this plus or minus change in cost is the internal product can be better than the external product or the internal product can be weaker than the external product. So if it's better, you will save some cost. If it's weaker, you will incur some extra cost. So depending on whether you are incurring extra cost for an internal transfer or you are saving a cost, you will add or minus. It's basically like true economic value, external purchase price, which is the alternative price, plus or minus value of performance differential, plus or minus value of performance differential. I will calculate price as per both. Affordability will say 140, availability will say 120. What I will end up paying is the lower of the two. What I will end up paying is the lower of the two. Anywhere you calculate, for example, if you have to calculate what is maximum selling price and you have 4 options to calculate it, the final maximum selling price will be the minimum of your answers. This is what I had explained in one area when I was doing decision making. When you are calculating something called as minimum transfer price and you have 4 options for that, the final minimum transfer price will be the maximum of the 4 options which you calculate. You will calculate as per option 1, option 2, option 3, option 4. There are multiple ways of calculating it. When you have multiple ways of calculating it, your final answer, minimum transfer price will be the maximum of the various answer. Maximum transfer price will be the minimum of the various answer. So some problem you will have data on affordability, some problem you will have data on availability, some problem you will have data on both. Now write transfer price split into 2. Minimum, maximum. This receiving is maximum, okay. Minimum transfer price, maximum transfer price. Transfer price split into 2. Minimum, maximum. Minimum, put a arrow mark down. Supplying division. Supplying division. variable cost plus opportunity cost or marginal cost plus opportunity cost. Minimum supplying division, variable cost plus opportunity cost or marginal cost plus opportunity cost. This is the ideal transfer price range. Okay, maximum two scenario: affordability, availability, affordability, availability, affordability and availability. If you have space, you can split affordability into two: constant, differential selling price, constant selling price, differential selling price, or else write like this. If you have space, split into two further: constant selling price, differential selling price, constant and differential. Constant is selling price minus further processing cost, selling price minus further processing cost, selling price minus further processing cost. Differential is NMR at optimum level by incremental units, net marginal revenue, NMR at optimum level, net marginal revenue at optimum level, NMR at optimum level by incremental units, NMR at optimum level by incremental units. Availability criteria: external purchase price plus or minus change in cost. Complete writing this. I'll give some notes beyond this. First you complete writing this: external purchase price plus or minus change in cost, net marginal revenue, net marginal revenue at optimum level, OL is optimum level, by incremental units. I'll again repeat: transfer price split into two: minimum transfer price supplying division, maximum transfer price receiving division. Minimum supplying, maximum receiving. Supplying division arrow mark down: variable cost plus opportunity cost or marginal cost plus opportunity cost. Receiving affordability, availability. Affordability split into two: constant selling price, differential selling price. Constant selling price minus further processing cost, differential NMR at optimum level by incremental units. Availability: external purchase price plus or minus change in cost, plus or minus change in cost. In minimum transfer price, in bracket you can write cost of make. Maximum transfer price is technically cost of buy. Minimum is cost of making the product, maximum is cost of buying the product. That cost of buy will come if you go with availability criteria. If you are going with affordability, it's not cost of buying, but your maximum is technically like cost of buying, as long as you will see problems where maximum transfer price will turn out to be lower than minimum transfer price. When you solve it, your maximum TP will be lesser than minimum TP. In that case, transfer should not happen. In that case, ideally a transfer should not be done. In that hotel example which I gave, the minimum transfer price would be 7,000. The maximum transfer price would be 6,500. The table will say transfer should not be done, which indirectly means you take an outside hotel for the accommodation arrangement. Okay, now below this write point number 1: minimum transfer price would be computed from supplying division point of view, supplying division point of view, there will be no opportunity cost, there will be no opportunity cost, there will be no opportunity cost if there is no capacity constraint, if there is no capacity constraint in supplying division. There is no capacity constraint in supplying division. If you have adequate capacity, you cannot charge any transfer price. If you have adequate capacity, transfer price cannot be charged. Sorry, opportunity cost cannot be charged. Point number B, maximum TP would be computed receiving division point of view. Receiving division point of view, it would be receiving division point of view, it would be lower of the following. It would be lower of the following. You will get two answers. Final transfer price is the lower of the two number. Affordability criteria. Affordability criteria. This transfer price will lead to zero profit / zero contribution or zero incremental profit, zero incremental contribution for the receiving division. This transfer price will lead to zero profit or zero contribution or zero incremental profit or zero incremental contribution for the receiving division. Affordability criteria will lead to zero profit. Affordability criteria will lead to zero profit. Clear? So, under affordability criteria, as it leads to zero profit, if you tell me to pay anything above this, I cannot pay, because this is the max I can pay. This itself will lead to only zero profit. Anything below this will give me profits. Anything below this. So, this is the maximum I can pay. They may discuss and then decide what transfer price is to be fixed, but the maximum I can pay is this much. Point number 2, availability criteria. This transfer price will ensure that outflow of receiving division is same whether they buy from outside / internal division, whether they buy from outside or internal division. This will not lead to zero profit at all, but I will not pay anything more than this, because outside it's available at 100 rupees, I will pay 100 only. You cannot ask me to pay anything more than this. Any doubts till this? Okay, let's take 2-3 examples for this plus or minus change in cost. Let's listen. External purchase price is 100. When I buy it from outside, the quality is not that great. So I have to do inspection. When I buy it from outside, I incur inspection cost of 10 rupees. When I buy it from outside, I will have to incur inspection cost of 10 rupees. This is for outside purchase. Okay. There are no other changes. Okay. Can you tell me what should be the transfer price for internal transfer now? Maximum transfer price 110. When I buy it from outside, I pay 110. Here also I will pay 110. I need not do inspection. Okay. Inspection is needed internal also. inspection is needed for the internal purchase also, but this inspection cost will be only 3 rupees. The inspection cost will only be 3 rupees. There is a need for inspection. There is a need for inspection. You need inspection, but the cost will be only 3 rupees. Can you tell me what should be the transfer price now? 107. Outside it is 100 plus 10. This is how I do it. Outside it's 100 plus 10. Internal is 107 plus 3. Internal is 107 plus 3. In both the places I want to pay 110. In both the places I want to pay. Another thing, this thing, inspection cost will be 3 rupees. But this cost will be incurred by the supplying division. This cost will be incurred by the division which is supplying the product. Division which is supplying the product. What should be the transfer price? Inspection cost will be 3 rupees. What should be the transfer price now? It will go back to 110 because I am looking from receiving division point of view. He is very clear. When he buys it from outside, it's 100 plus 10. When it comes from in-house, it's 110 plus 0 because I don't incur inspection. I don't incur inspection. This 3 rupees will go part of variable cost when he does his analysis, supplying division. So I am not coming to the supplying division angle as of now. Receiving division will now be ready to pay 110. No, 107 both has to add up to 110. Because I don't want to pay anything extra. When I buy it from outside, I am paying 100 plus 10, 110. When it is internal, I want to pay 110 rupees. Suddenly then you are saying, in that 110 you have to spend 3 rupees on inspection. Then I am saying, okay, balance 107, I will pay as transfer price. See, I made my mind clear saying that I will give 110 rupees for this product. If you inspect and give me, I will give you 110 fully. If you want me to inspect, I will pay 3 rupees for inspection and give you 107. So my mindset was very clear saying that I will pay 110 rupees because from outside I was paying 110. Okay, I go back to this inspection example itself. When I buy it from outside, the product is delivered in my factory. The product is delivered in the factory. When I do an internal transfer, there are two separate factories. So I have to incur some logistics cost. I have to incur some. So internal transfer, there is a transport cost of 25 rupees. For internal transfer, there is a transportation cost of 25 and this as a receiving division I have to pay. This as a receiving division I have to pay. No inspection needed. Inspection is not needed. But when you buy it from outside, you have to pay 10 rupees for inspection. No transportation cost. No transportation cost. 10 rupees have to be paid for inspection. When you do an internal transfer, no inspection but 25 rupees have to be paid as transportation cost. Tell me what should be the transfer price now? 85. Outside 100 plus 10. Internal question mark plus 25. Internal question mark plus 25. My mindset is very clear. I have to pay the same amount at both the places. So sometimes differential in cost will be added. Sometimes difference in cost would be subtracted. So I cannot say it has to be added or subtracted always, because few places depending on whether are you saving extra money, not the base price. Base price nothing can be done. Your other cost, if you are saving money, you will pay extra on the base price. Other cost, if you are spending more, you will reduce the base price. Net my mindset is very clear. The question can even go on adding saying that if you buy it from outside, there will be some rejection. This rejection will cost you 25 rupees. When you do an internal transfer, rejections will not be there. So outside 100 plus 10 plus 25. Internal question mark plus whatever extra cost you incur equal to 135. I need to pay the same amount. My mindset is very clear. I don't want to pay anything extra. I want to pay, this is my maximum. If I am paying lesser, then that's an advantage for me. So I have a minimum transfer price, which this guy will say, this will give me the maximum transfer price. If minimum is 80, maximum is 120, both can negotiate and fix a price in between. Anything above 80 is the benefit for the supplying division. Anything below 120 is the benefit for the receiving division. So both can negotiate and decide where they want to fix it. In that hotel example, 1500 is the minimum transfer price if there is no opportunity cost. Maximum transfer price was 5000 if you get it from outside. If they can discuss together and then say we want to fix a transfer price of 4000, it will be win-win situation for both. Both will have a win-win situation. First division will make some money, second division will also make some money, company will also be benefited. The profit or the loss for the company from the transfer is the gap between maximum TP and minimum TP. If maximum TP is 120, minimum TP is 80, this gap is the profit for the company. This gap is the profit for the company if transfer happens. Unfortunately, if transfer does not happen, this is like an opportunity loss. This is like a opportunity loss. Again I am repeating, transfer price, for example in that hotel example, if minimum is 1500, maximum is 5000, by doing a transfer in my profit and loss account I may not show extra profit and all, but technically what happens is, if I use my own accommodation, I will indirectly save 3500, which will lead to extra profit. What is that 3500? Is the gap between maximum and minimum. If this is 7000 and if this is 6500, you will say transfer is not to be done, and if you end up doing transfer, you will lose 500 rupees. The gap will be the loss for the company. So it can be profit for the company, it can be loss for the company, as long as maximum transfer price is higher than minimum transfer price, then you go ahead with the decision. Now next point, maximum transfer price in bracket affordability criteria, or okay, first not write affordability, maximum, if you first write this, if maximum transfer price is more than minimum transfer price, transfer is feasible. Maximum transfer price is more than minimum transfer price, transfer is feasible. In such a scenario, transfer can happen. If maximum transfer price in bracket availability, the maximum transfer price can come from availability criteria, can also come from affordability criteria. The price can come as per availability criteria, or it can come from affordability criteria. Let's assume I calculated the maximum transfer price and that has come as per availability criteria, lower of the two number. If maximum transfer price availability is lower than minimum transfer price, transfer should not be done, and the company should buy intermediate product. What is intermediate product? Is the product which is transferred from one division to the other division. That's called intermediate product. Whatever product is getting transferred or whatever service is getting transferred, company should buy intermediate product from outside. That is, in this example, if it is 6500 vis-a-vis 7000, it means maximum is lesser than minimum. Please don't use internal services. Get this hotel accommodation from an outside hotel. If this maximum transfer price comes from availability criteria. Next point, if maximum transfer price in bracket affordability, is lower than minimum transfer price, transfer should not be done, and the company should discontinue sales of product of receiving division. Receiving division. See, I am making a product, I process it further, and the second division was planning to sell it. First division says you have to pay me 50 rupees, that's the minimum I want. Second division says I can afford to pay only 40 rupees, which means if I put this product to the second division and tell them to sell it at 50 rupees, if I fix a transfer price and transfer, they will make losses. Because affordability criteria leads to zero profit, zero loss. So if the second product cannot meet the minimum transfer price as per the affordability criteria, then it indirectly means that second product is not feasible. That's not a good product to be sold by the company. It is good to sell it as the first product itself. So we do decision on further processing. We have done problems on decision on further processing, where if you remember, we used to write sale value after further processing, sale value at split off, incremental revenue, incremental cost, further profit or loss. If the incremental profit is loss, we say sell at split off. If incremental profit is positive, we were selling sell after further processing. The same logic works here. If that second product cannot even meet the cost of the first product, the intermediate product, please don't transfer it. If you are not transferring, the second division cannot operate itself. You will have to basically discontinue that product. If it was as per availability criteria, then at least you have an option of buying it from outside and continue running your operation. But if the same comes as per affordability criteria, stop operation. You don't have a choice. You don't have a choice. You will have to stop the operations. Clear? Any doubts on this? Okay. Now let's just quickly look at this. Transfer price will serve the following utility: performance evaluation, employee engagement and compensation. Both are technically same. Both are technically same. It is used for the purpose of performance evaluation, basically to pay bonus. Resource allocation, taxation and profit remittance. This is more from an international transfer pricing point of view. Taxation and profit remittance will also be one of the important factor, because people started exploiting this. What happens is, India, Singapore, India 50% tax rate, Singapore 10% tax rate. Let's assume India is selling something to the Singapore branch. What Indian entity will do is they will fix a low selling price. Low selling price will lead to lower profits in India. Singapore entity will have a low purchase price. Low purchase price will lead to higher profits. And for that higher profits, you will end up paying. So in India, let's assume you make a profit of 10 lakh. In Singapore, you make a profit of 40 lakh. If you increase or reduce the price, this can come down, that can go up. At a PBT level, 10 plus 40 will add up to 50 only. At a PBT level, 10 plus 40 will add up to 50. You change the transfer price, 10 can go up, 40 can come down, or 10 can come down, 40 can go up. You can keep playing with this. Your one profit will go up, another profit will come down, or the other profit will go up, this will come down. That is at a PBT level. What people started exploiting is they felt this is higher tax, so show lower profits in India and show higher profits in the other country. That somehow people started exploiting. That's where your ALP came, arm's length pricing came into picture, and because of arm's length pricing, your transfer pricing has provisions on that. They say that you will have to do an arm's length pricing. Arm's length pricing is basically the price which you would charge if you are charging to a external person. Not only income tax angle, there is also a customs duty angle which can also come in. If you are buying something, what can happen is, if you fix a low price, you will pay lower customs duty. So you can even try to play around that. There also arm's length provision comes into picture. Transfer pricing is often associated with the term arm's length price. This implies that the price for internal transfer has to be fair and competent enough if dealing with a third party. This is okay as long as you are doing some international transaction. For an internal transaction which is within the two divisions of the company, you can fix any price. Tax authorities are not going to ask you anything. Tax authorities will not come, because from a tax authority angle, it's neither revenue nor cost, so they are least bothered about all this. So you do whatever you want to do. Application of concept of arm's length pricing is more from a taxation perspective. It's not from the perspective of internal divisions. Even for external division, one in India and another one in Singapore, for the purpose of performance evaluation, you may work with minimum transfer price and maximum transfer price as per what the formula I gave. I gave you certain formula saying that minimum transfer price has to be variable cost plus opportunity cost. Maximum transfer price has to be your external selling price minus further processing cost, or NMR at optimum level by incremental units, or external purchase price plus or minus change in cost. Okay, I think I should have removed this example. This example I have removed certain data, so let's leave this. These are the transfer pricing methods. Just give me a minute. Okay, these are your methods you have. So This is what was covered in my PPT even for the last session. The only thing is they asked the methods, on top of the methods they wanted you to write the advantages and disadvantages, which is there in the detailed theory, but it was not there in the summary theory. So this came as an exam question. My summary theory did not have this. Mostly summary theory will cover everything, but I did not think that something like this would be tested. So the summary theory did not have. So you have multiple approaches. Market based approach. Market based approach is technically your affordability criteria, or sorry, technically your availability criteria. What is market based is external purchase price. Based on the market price of the product, you charge the transfer price. Cost based can be marginal cost based, means consider only the variable cost. Standard cost based means you charge a fixed transfer price irrespective of what cost you incur. You fix the price, because if you are incurring extra cost, you will increase the transfer price. If you are saving cost, you will reduce the transfer. This is illogical, because what will happen is, if the first division is inefficient, they will charge a higher transfer price. If they are efficient, they will charge a lower transfer, because if you are efficient, your cost will come down, transfer price will also come down. If you are inefficient, cost will go up, transfer price will also go up. So you don't want this to happen. So many organizations go with a standard cost based. In a standard cost base, what will happen is, irrespective of the cost you incur, the transfer price would have been fixed. The transfer price would have been fixed. Once that happens, as a division, what I will think is, if I save some money, my profit will go up. If I save some money, my profit will go up, because transfer price is already fixed. Transfer price is already fixed. Otherwise, what will happen is, if you save cost, transfer price will come down, you don't gain anything. If you increase cost, transfer price will go up, you don't gain anything. So normally you will go with a standard cost based method rather than your marginal cost or full cost based method. Negotiation based method is basically you will have to discuss, you have a range, based on the range you decide what transfer price you want to fix. Just go through the advantages and disadvantages also, because it has come in one of the exam. So just go through this, page 161. Transfer price is based on market price of goods or services adjusted for any cost that can be saved by internal transfer. Technically, external purchase price plus or minus change in cost. External purchase price plus or minus change in cost. What is intermediate good in this example is, the product which is transferred from one division to the other division is called intermediate product. What is intermediate goods? Indirectly they want to say is, there are some products which may not have an outside market. There is no outside market for few products. If you don't have an outside market for few products, then what will happen is, you cannot get a market price for that. You cannot get a market price. So I do step 1, step 2. So for example, when you manufacture a shirt, the basic raw material is called raw cotton. Then it becomes a ginned cotton, then it becomes a spun yarn, then it becomes a fabric, then finally the garment comes into picture. So there are so many processes, and in the practical world, each of this has an outside demand. Each of this has an outside demand. So when you have an outside demand for something, it is fine. But there are certain products which cannot be sold. Like for example, in a practical world, I can sell yarn, I can sell cotton, I can sell fabric, I can sell garment. Everything can be sold. But if something cannot be sold, then for those products, market price based method will not work. Shared profit relative to cost base, I will explain later. This is not a separate method. This is basically how to calculate profits for the divisions. You can quickly read through the cost based methods. If you do it on the basis of cost, go through this, I will explain them. The problem is with this, the main issue is this. This can be kind of sorted out if you go with a standard cost method. If you go with a standard cost method, this can kind of be sorted out, else this is a problem, because if cost increases, pass on the increased cost. If cost reduces, pass on the benefit of the lower cost to the next division. So supplying division is thinking anyway my profit is going to be 0. Why should I try to put extra efforts? My profit is anyway going to be 0. Whatever cost I incur, I'll have to pass it on to. There's another method called cost plus markup. There, if you increase cost, your profit will go up, because if cost is 80, profit is 25% of 80. If cost increases to 100, profit is 25% of 100. So cost plus markup is another issue where what will happen is your profit will go up if cost goes up. This method is the preferred one, because here you can do an objective performance evaluation. Other methods performance evaluation will not happen. Be it in this, that method 1, method 3, method 4, all that you can talk about one disadvantage, which is the disadvantage of passing on the increased cost to the next division or passing on the benefit of the lower cost. So there is no incentive for the supplying division, and if you don't add any profit margin, because I said the minimum transfer price is variable cost. If I have to transfer it, for example in that ITC, if I have to say that the hotel division has to give it at 1500, the manager is saying I am not interested. What is the point of giving it 1500? Anyway, we are not going to make any money. For that matter, let's leave it idle itself. What is the point of transferring it to the next division? Because if I give this to the next division, he will get it at 1500. He saves a lot of money. I don't earn anything. I technically don't earn anything. Because of this, the method comes as your negotiation based. So you decide what you want to do. You will consider external price, you will consider cost, you will consider everything into picture. Basically the negotiation will happen based on that range which I gave, minimum transfer price range and maximum transfer price range. Minimum transfer price is dependent on variable cost, opportunity cost, maximum transfer price is dependent on selling price, further processing cost, external purchase price. So all this would be considered, and then you fix a final price. The most important issue with the transfer pricing situation is, because I give you full freedom, I will end up giving full freedom to both the managers. If for example in a big four you will see multiple divisions being there. So when there are multiple divisions, there is a tax department, there is a audit department. So when you are doing an audit, sometimes you will need the services of the tax department for completing the audit. When that happens, you would take the division, there will be some internal charge needs to be made. You will have to charge some value from one division to the other division. When those charges are being made, because of full freedom being given to them, if you end up charging a very high price, you may think whether to use an internal division or let me try to use my own employees, and then I try to save on some cost, something you try to do, where what will happen, the quality can get impacted, all those issues can come. This is an example of a big four, but there are other examples where instead of taking my own division, I will take it from outside. I can even go ahead and take it from outside. When I take it from outside, I will save cost, but the company as a whole is going to lose. So what is goal conflict is, if either of the two division do not agree to the right decision. What is the right decision is, I instruct saying that division A should transfer 20,000 units to division B. That's the right decision. Division A is adamant saying that they will transfer only 10,000. Why 10,000 is happening? Because of wrong transfer price, because of the wrong transfer price. Or division B saying I am ready to take only 15,000. I am ready to take only 15,000. Again could be because of wrong transfer price. If that happens, that's a conflict. If that happens, that's a conflict. If that does not happen, then you are in a situation where you are goal congruent, you are not having any issue. This also is seen not only from a two divisions point of view. Let's assume there is only one company. If I am the owner, my personal interest and the company interest is same. The personal interest of mine and the company's interest is also same. If I am the owner and I tell someone else to manage my business, there is something which happens called as agency problem. What is agency problem is, company wants to maximize profit, but this guy wants to maximize sales. Why? Because his profits is dependent on maximum sales. His profits is dependent on maximum sales. So that's again a conflict. You will have to resolve the conflict. Conflict will be resolved if you keep this. Minimum transfer prices, additional outlay. What is additional outlays? Variable cost or marginal cost. Additional outlays, variable cost or marginal cost plus opportunity cost. Additional outlays defined. Marginal cost plus any additional cost incurred by the supplying division. Maximum transfer price, lower of net marginal revenue and external purchase price adjusted for saving or increase in cost. What is net marginal revenue? Is the external purchase price minus further processing, external selling price minus further processing cost is technically called as NMR if it's a constant selling price. If you have a differential selling price, we call NMR at optimum level by incremental units. I'll anyway talk about this later. And you have external purchase price plus or minus saving in cost. If you go by net marginal revenue, you are going by affordability criteria. If you are going by external purchase price, you are going by availability criteria. This and all is of the same thing. If you have excess capacity, you will not have opportunity cost. If you don't have excess capacity, you will have opportunity cost. For us, the formula is the same. There's only one formula, which is plus opportunity cost per unit. The opportunity cost can technically be 0. Clear? Any doubts on this? Okay, there's something called as proposal for resolving conflict and international transfer pricing. I'll cover them once we start doing the problem. So I'll start doing the problems from the next session. We'll end with this. If there are doubts, I can take it up. So we have two approaches. One is called dual rate transfer pricing system. This system will complicate your accounting records. Now, how does this complicate accounting records? Is electrical division, household division. Electrical division will record transfer prices 25. That is, they will say revenue is 25. Household division, when they get this product, they will record the intermediate product cost as only 18 or 16. Sorry, only 16, which is the cost of manufacturing. First division will say selling price is 25. Second division will say cost of this is not 25, it's only 16. It's only 16. Why you take it as 16 is 16 is basically the cost of the company. 16 is basically the cost of the company. So when you take it as 16, transfer price will not impact any decision. Transfer price will not impact any decision. Moment you take 16, you are technically analyzing it from the company's point of view. You are technically doing the analysis from the company's point of view, not analyzing it from the individual division point of view. The only problem is this will complicate your accounting records, because first division will say profit is 10 lakh, second division will say profit is 5 lakh. 10 plus 5 is not company's profit. 10 plus 5 is not company's profit. Why will it not become company's profit? Because you unnecessarily inflated the profit. You have inflated the profit of the household division, or you have inflated the profit of electrical division. One division you are inflating the profit. Here the transfer will happen at external selling price, or technically it will happen at the minimum transfer price, which includes the opportunity element. This guy will record the transfer only at variable cost. Now electrical manager is happy because he is supplying it at 25. Household manager is also happy because he is getting it at 16 and he is reporting profits. So first division manager is also okay, second manager is also okay. The only headache is accounting records will get complicated. So proposal for resolving TP conflict, this is in your initial theory. Dual rate transfer pricing system. Supplying division can record transfer price by including a profit margin. Purchasing division will record at cost. Promotes goal congruence, because the second division will operate as if company is taking the decision. Accounting records will be complicated and can lead to a scenario of artificial profits. Clear? Any doubts on this? Second is two-part transfer pricing system. This will not be applicable in this question. In this question it's not going to help, but in some other question it can help. What two-part transfer pricing system says is, transfer will happen at variable cost. Any units you transfer, the transfer will happen at variable cost, plus there will be a lump sum consideration paid. What is lump sum consideration is, whether you transfer 10,000 units, 20,000 units, 30,000 units, 40,000 units, 50,000 units, you will be given a lump sum consideration. The lump sum consideration is basically for the capacity which you use. So in this question they can say transfer will happen at 16 rupees, plus you will pay a fixed amount of 5,000 rupees, 10,000 rupees, 15,000, 20, 25, any number you can decide on. Now what happens because of this is, when you do your transfer pricing analysis, just give me a minute. This was the first problem we had done. 5,090 rupees was the transfer price. Here the cost I think was some 67.5. So what they will say is, transfer price will be 67.5 plus a fixed amount of 2 lakh. Any number, okay? They can decide any number, plus a fixed amount of 2 lakh. When you do it this way, let me make it not 2 lakh. In this question, let me make it 2 lakh 50. When you make it this way, here this division will always operate at the optimum level. They will operate at the optimum level, which is 15,000 units. They will operate at the optimum level because in their cost calculation, the variable cost will be the same. So indirectly, what gets subtracted is the variable cost at every level. That lump sum consideration is same for all the levels. The lump sum consideration is the same amount for all the levels. In that problem, 90 was a wrong transfer price. So here what you will say is, you don't fix transfer prices 90 rupees, please fix it as 67.5 and you pay a lump sum consideration. This can be even 5 lakh rupees, okay? Can be even 5 lakh. Still they will take the optimum decision. The decision is 15,000 units. The decision is, if you remember that problem, there the optimum level was 15,000 units. So when you pay a lump sum amount, transfer price will not impact the decision of the second division. Transfer price will not impact the decision of the second division. So the method says pay variable cost plus a lump sum consideration, which will not work in this question, because here you would want the lump sum consideration to increase at every level. You would want the lump sum consideration to increase at every level. Why do you want to increase? Because you are losing opportunity cost at a per unit level. You are losing opportunity cost at a per unit level. If you are not losing any opportunity cost, then what I can tell him is, please get your variable cost. Along with that, you will be paid a fixed amount of 1 lakh rupee. I am happy about it because I will be able to use this 1 lakh to recover my fixed cost. This will also promote goal congruence. May not be that much useful for the given question. May not be that much useful for the given problem. So the second option is two-part transfer pricing system. Marginal cost 16 rupees plus lump sum charge. Here accounting records and all will not get complicated. No complication on accounting records. All those issues will not be there. The only thing is, this will ensure the decision which the person is taking is in line with the goal congruence thing, or is in line with what the company wants to do. Supplying division can recover marginal cost, and a lump sum charge will contribute towards recovery of fixed cost. Purchasing division will buy goods at lower price as compared to market price. This lump sum consideration which you are fixing, you should fix in such a manner that the overall amount which you pay at a per unit level is lower than the market price. That is what technically will be. This lump sum consideration is going to be a negotiation between the two parties. Only thing it will ensure is, this will ensure that transfer price does not influence your final decision. I want whatever problems you have done till now, any problem you go and say that the first division, variable cost plus a fixed amount, they will choose the optimum level. The second division will also choose the optimum level. Company is happy about it. Or you fix the transfer price between the range. Here between the range is what I want to do, but still the second division will crib about it because they are going to report losses. They are not going to be okay with it, because if they report losses, they have problem, because ROI is a measure of performance evaluation. I give you maybe some 3-4 minutes, because it's a 20-mark question. There is no major analysis. You can just quickly go through this part. You can quickly go through this part. Net, it's the same thing. I don't know why they ended up asking us 3 different parts. It's a similar requirement. Now I get into international transfer pricing. Now when you do international transfer pricing, listen, this is just for more for understanding. In problem solving, this area may or may not come. I fix my minimum transfer price, variable cost plus opportunity cost. For the time being, understand there is no opportunity cost. Let's assume a company produces a product and cost is 6,000, market price is 10,000. There is no capacity constraint. There is no capacity constraint. So you don't have any capacity constraint. So you should ideally transfer it at 6,000. This is Indian entity, and the receiving is Singapore entity. So you transferred it at 6,000. You transferred this at 6,000. Now suddenly a question came from there. A question came from there saying that, why did you transfer it? This is the question has come from the income tax authority. Income tax have asked, why are you transferring this at 6,000 when you are selling in India at 10,000? What is the logic of transferring this at 6,000? So arm's length provisions came into picture, your taxation provision, and they said you transfer at whatever price you want to do. We are least bothered. From our point of view, transfer will be at 10,000. From our point of view, transfer will be considered as if you have transferred this at 10,000, whether you transfer at 0, 1000, 2000, 5000, 7000, 8000, 9000, I am not bothered. From our point of view, this transfer has happened. This transfer has happened at a price of 10,000. This transfer has happened at a price of 10,000. If that's the scenario, you pay tax on ALP basis, tax on arm's length basis. Because what tax authorities will say, every unit you transfer, you make a profit of 4,000. You make a profit of 4,000. 4,000 into 25% you pay in India. 4,000 into 25% you pay in India. You are transferring it at 7,000, profit is still 4,000. You are transferring it at 8,000, profit is still 4,000. You are transferring it at 9,000, profit is still 4,000. You are transferring it at 10,000, profit is still 4,000. You transfer it above 10,000 also, technically profit is 10,000. Profit is 4,000 per unit. So irrespective of the price at which you transfer, Indian entity will have 3 outflows. One is variable cost of 6,000. If at all any opportunity cost is there, which is not there in this question, and third, they have to pay income tax of 1,000 rupees. Third, they have to pay income tax of 1,000 rupees. So in your minimum transfer price, there will be an extra component called as tax based on arm's length provision. Tax based on arm's length provision. TP fixation may not be asked in exam. They will not ask you to do TP fixation. They will give you a transfer price and then ask you which is the right transfer price or which is a better transfer price, or a profit statement would be asked. But logically, I don't need only 6,000. Assume I transfer at 6,000. So my cost is 6,000. I transfer at 6,000. Unfortunately, I still have to pay tax of 1,000. I still have to pay tax of 2,000. If I transfer it at 7,000, I will incur cost of 6,000, pay income tax of 1,000, pay income tax of 1,000 irrespective of the profit I make, irrespective of the profit I make. Clear? Any doubts on this? When it comes to your maximum transfer price, ignore the affordability criteria for the time being. If you go with availability criteria would have said external purchase price plus or minus change in cost. in the external market you are buying it at 200, you are buying it at 200. So now what you said is, in the external market I am buying it at 200, you please transfer it at or for example in this example you got 7,000 here, you are buying it at 8,000, let's assume you are buying this at 8,000. So you say please transfer it at 8,000, that's the maximum transfer price. Then there's another angle here. The angle is, when you transfer at 6,000, tax authorities consider it as 10,000. Similarly, if this division buys it at 8,000, they may still get a tax benefit for 10,000. Logically, they should get a tax benefit for 10,000. So technically, if the transfer happens at 8,000 also, if the transfer happens at 8,000 also, there's an extra tax benefit on that 2,000 rupees. There's an extra tax benefit on 2,000. What is that 2,000? 10,000 minus the 8,000. Earlier you were buying at 8,000. In your books of accounts, 8,000 was an expenditure. You are getting a tax benefit of 20%. Now in your books of accounts, whether transfer happened at 6, 7, 8, 9, 10, the transfer price will be recorded as 10,000 or the purchase price will be recorded as 10,000. So if you record 10,000, you will get a tax benefit of 2,000 rupees. Earlier you were recording a purchase price of 8,000, you are getting a tax benefit of 1,600. So I say external purchase price plus or minus change in cost. Because of transfer, there is going to be an extra tax benefit that can be adjusted with the transfer price. That can be adjusted with the transfer price. The second division can pay 8,400. Why they are paying 8,400 is, 8,000 they were earlier paying, 8,000 they were earlier paying this amount, and 400 tax benefit will come. How is that 400 tax benefit? Earlier you were paying 8,000 and getting a tax benefit of 1,600. Now you are paying 8,000 or whatever, 8,400. There is a tax benefit angle. What is the tax benefit angle? Extra 2,000 value from books of accounts point of view into that 20% tax or 10% tax. This adjustment mostly will not be required from an exam point of view. They may not ask you to fix the transfer price, but what I wanted to convey to you is, your tax will also become one of the part in your minimum transfer price and maximum transfer price. I think I have one problem on this. When I do that problem, you may understand it better, but for the